During your working years, you are much more likely to suffer an accident or a sickness than you are a death event. So if you have 4 25-year-olds in a room today, one of those 4 will suffer at least a 90-day long disability event prior to their age 65.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is episode 99. On today's show, we're going to focus on disability insurance and some of the key questions you might have around that. And I'm thankful to have a special guest today, Tim Kukieza. Tim comes to us from Ash Brokerage and specializes in disability insurance. Welcome, Tim.
Ryan, thank you very much for having me. I appreciate it.
Yeah, I'm really excited to have you on. We had talked a little bit about before we started recording about some of the key areas that people need to think about with disability insurance. But before we jump into that, tell our listeners a little bit about yourself and how you got involved with disability insurance.
So I'm based out of Pittsburgh, Pennsylvania, have been my entire life. And I started in the insurance business now almost 30 years ago. And in my entire career, I've been in the disability space. So whether that's through a BGA like I'm currently with, whether that's through specific carriers, but in my 30-year career in insurance, I have been focused in the disability space.
Okay, awesome. Well, I'm glad we can tap into your expertise today. So for those people, I think a lot of people probably heard about disability insurance, but maybe some people don't really understand it. Like, what is disability insurance? What does that do for someone?
Yeah, the key is in the phraseology is something that we're trying to change from an industry side of things, because just like life insurance, and of course, life insurance policies that pay at a death event, but it's not called death insurance, right? So for disability insurance, the connotation is a negative one when you talk about disability insurance, because truly it's income protection insurance based upon a sickness or an accident. And if people can understand that approach versus the idea of not ever becoming disabled, people get sick in accidents every day. And this type of policy protects your income around if you can't get up and go to work because of a sickness or an accident. And we've seen that now from a health standpoint or just from a financial standpoint, with COVID and everything around COVID. Now, this policy doesn't pay you if you're just laid off from your job or your job closes down for something like COVID. But if you're sick or hurt, this is a policy that will replace your income. And again, the idea of disability insurance puts clients off a little bit when they hear that wording.
Yeah, I think we all probably don't ever think it's going to happen to us, right? Are we going to be the person that's in that bad car accident or has some injury that prevents us from going to work or, earning a paycheck? Like, how likely is it that someone will, become disabled? This will happen to someone.
Yeah, that's always a concern with clients around the idea of I'm buying this type of coverage and, I don't ever plan on getting sick or hurt. And that's something that I hear from in the industry on a daily basis. And nobody ever plans on getting sick or hurt. That's for sure. I mean, people don't wake up in the morning and say, well, today's the day I'm going to start feeling bad and I got to figure out how to address that situation. But to your point, we all know eventually we're going to pass away. So the idea of life insurance in a death event is always there, basically. It's just a matter of when. During your working years, okay? And that's where the income protection comes into play. During the working years, you are much more likely to suffer an accident or a sickness than you are a death event. So if you have 4 25-year-olds in a room today, one of those 4 will suffer at least a 90-day long disability event prior to their age 65. So 1 in 4 25-year-olds. So again, it's never somebody ever thinks about, but these things happen to people every day.
So when you're thinking about it, like, how much coverage does someone need? Do you need your whole paycheck covered? More than that?
Yep. And let me finish one more thought process on the previous question. 90% of all income protection situations are illness related, not accident. So again, it's the cancer, it's the stroke, it's a heart attack. So yes, accidents do happen. And of course, they're tragic in nature at times, but it's illness related situations, again, that cause people to have an income protection situation. So from the idea of coverage standpoint, what you look at is from the policy itself. The first thing you have to realize as a client is your actual income isn't your take-home pay. So if you're taking home $1,000, or if you're making $1,000 a month, you're taking home, let's call it $700 of actual spendable income. Okay. In that situation, the DI policy will replace up to $600 of that amount of coverage for you. And in that, if you use your after-tax dollars to pay for that policy, then those benefits are tax-free. So you got $700 versus $600. The DI companies want to try to incentivize you to try to get better, but they're going to protect a good portion of your income. Now, you can always back off of that amount from a premium threshold, but that's the math typically when you look at it.
So that sounds like that was 60%, I guess, in your example of somebody's $1,000 a month of income. Is that kind of like an industry norm, 60%?
Yeah, that's the math that everybody uses. And 60% to some people doesn't sound like enough. And you're right. The 60% is your gross number. But when you actually work at it from a take-home pay and a non-taxable policy paying you, the actual ratio gets closer to 85% of your actual take-home pay versus your policy proceeds. But the 60% is based upon your gross pay.
Okay, because of the fact that it's all, if you own the policy, as you said before, it's not taxable to you.
If you're using your after-tax dollars to pay for that policy, like you pay your heating bill or your lighting bill, you're going to receive those benefits on a tax-free basis.
Okay, yeah. So, that kind of jump ahead. So I guess you could buy an individual policy, and then you also could buy a group policy, let's say, or be eligible for one if your employer offers that. So if you sign up for a group policy, does that mean that then that money would be taxable, or do employers give you the benefit to pay for that with after-tax money too?
Yeah, the majority of all group policies, again, you mentioned I'm with Ash Brokerage, and Ash Brokerage provides us a really nice benefit package as an employer, right? Most employers, if they provide group disability benefits, are going to pay the premium 100% for you as an employee. Therefore, you're going to receive those benefits on a taxable basis. So that group plan, again, now gets to the idea that it's a still 60% replacement ratio if you have the employer-provided plan. But now you're getting 60% and you're getting taxed on that 60%. So in essence, let's call it 45% that you're actually coming home with. So we can supplement that and add it back up to the 60% with a small individual policy. But a lot of people in no way could live on 45% of their income replacement if something happened to them, even though they have employer-provided coverage. It's just not enough.
Sure. So I guess what would be the positive of a group versus an individual? Like, I guess there must be a benefit to that, right?
Yeah. I mean, for a lot of employers, as soon as you become an employee, you're going to get the group benefit, so you can't even opt out of that plan, okay? So the benefit is it's provided to you as a no-cost benefit in most situations, which is fantastic. The downside is, again, one is it's taxable to you, so that 60% replacement goes to 45%, and two is it's not portable. So if you would leave that employer and you have some medical condition that was already being covered, but now you go change jobs, we receive a number of calls from advisors that have clients that are concerned about moving away from their current employer because they have health conditions. And if they go independent, they may have a problem getting coverage on their own. And that's another positive aspect of the group side of things, is you're covered for everything. But if you leave, they're typically not portable.
Sure. Yeah. I could see that being a challenge. So we'll talk about the group plans. There's usually both short-term and long-term, right? They break that down. How long does short-term usually cover you for, and when does that kick in paying?
Yeah, short-term plans are becoming harder and harder for you to see as employees out in the marketplace. But a short-term plan, if you have it through your employer, is typically a 7-day waiting period for both accident and sickness. So it's 1 week, if you will. So if you get sick or hurt, you're going to use your PTO or MTO or vacation time to get through that week. And then you'll start collecting on short-term disability, which is usually a 70% replacement versus 60. So you'll go from 1 week typically out to about 90 days. And then at 90 days, Your long-term disability plan kicks in, which now reduces you back to that 60%. And that long-term plan typically covers you to Social Security retirement age. But there are a lot of employers out there that don't even offer the short-term coverage any longer. So if you become disabled and you have that 90-day wait, you've got to figure out how to get through that 90 days before your long-term disability plan kicks in.
Okay. How come employers have gotten rid of their short-term coverage?
It becomes very expensive because, as you can imagine, with a 7-day accident, 7-day sickness plan, it's not hard to file a disability claim for being disabled for 7 days. That also includes maternity leave. So if females have a pregnancy situation, they're actually covered for that under maternity. So cost-wise, the short term becomes very expensive to the employer.
Yeah, I know with my wife that she works for a hospital, and with both of our children, she qualified for the short-term disability. But again, it's also a way too that a company didn't have like maternity coverage, right? Because then they don't have to cover you per se. They just push you over into the short-term disability plan. So I guess it's better for the company maybe, but yeah. I know like some states too have gone, like where I'm in Connecticut, they have like I don't know if it's actually called like, it's like a paid leave program where it does cover you up to 26 weeks. I guess if a company didn't have short-term disability, that could kind of fall under that, right?
Yeah, to the best of my knowledge, there's only 6 states out there that have a state-mandated type of plan. Now, that's different than workers' comp. Workers' comp is a mandatory plan in most states that covers you for on-the-job accident or sickness, okay? You're referring to a 24/7 type of plan that actually covers you for accident and sickness, but there's only 6 states that I'm aware of that actually have that plan that your employer is mandated to pay for that does cover you in that short-term basis in those states.
Yeah, I think Connecticut's one of them, but right, it's not many, right? It's majority of them do not have that. So talk a little bit too about, so you mentioned too, the typical long-term disability covers you until Social Security age. Is that, I used to hear that it was 65. That was when you used to be eligible for full Social Security benefit. Now that's between 66 and 67. Is that the most policies go to 65 or do some of them go to 66 or 67?
The group plans will go to whatever your age is now to whatever your Social Security retirement age is going to be. Like for a 25-year-old, like you said, if they become severely disabled and live that long, they're going to collect benefits until the age of 70 because most likely that's when their Social Security benefits kick in. On the individual side of the house, we can design the plan that has a benefit period that's either a 2-year, 5-year, 10-year, 65, 67, 70. So based upon your age, that'll protect you out to Social Security. But you can also, again, buy less of a benefit period, and that'll keep the pricing down for you as an individual. For example, if you buy a 2-year benefit plan, that keeps the price down. But if you're still disabled after 2 years in that example, your benefits will stop because you only bought a 2-year benefit plan. But at least you've had coverage for those 2 years.
Sure. Yeah. So let's jump into the individual plans a little bit. So I would say for people, if they're either self-employed, right, or they have a company that doesn't have a group plan, or like you said, their group plan only covers 40%, and that's not going to be enough for them to live on, that's probably when they need to start thinking about an individual plan. Are there other instances too when maybe they'd want to think about that?
Yeah, to your point, my thought process again, and I've been doing this for a long time, when you look at the households today, whether you're one income or two, income right now, based upon everything that you do, is your most important asset. You can own your house, you can own a car, you can own a boat, you can own a second home. Okay. All of that stuff is typically paid for with your income, unless you're very wealthy, right? And if your income is adjusted because of anything accident or sickness wise, that's going to impact your daily living all the time in every way. So from my side of things, if you have an income, and even if you're a dual income household, it would be very hard for that income to live on one income if the second income went away for whatever reason, right? Some level of income protection is critical to the financial success of your household, literally, right? And I've been in the business for a long time. As I said, I have hand-delivered claim checks to claimants who have a disability event. And understanding that they haven't passed away, but their financial obligations are still there for them and their family, they are emotionally moved with the idea that they can focus on getting better health-wise as opposed to how am I going to pay the mortgage? How am I going to pay this or that? Because now at least I have a baseline income coming in the door.
Yeah, no, I would agree. That's very important. Yeah. So what process do you suggest people go through, like if they're trying to determine, all right, how much do I need for, an individual plan? Where do you suggest they start with that?
Yeah. So, just looking at your financial picture, do you have group LTD through your employer? Then what we talk about is a supplemental plan to make up for those taxes. As you just mentioned, the math becomes 40% replacement from a take-home pay. Most people couldn't live on that. So you get it back up to that 85% threshold. Okay. You look at, again, if you have no income protection whatsoever through your employer, how do we design a plan for you as a client that's affordable for you, that's still as comprehensive as possible, right? Is it a 2-year benefit plan? Is it a 5-year? The elimination periods. So the idea, again, how long am I disabled until I start getting paid? We talked about the short term being like 7-day accident, 7-day sickness. In the individual space, you can go as low as 30 days if it's not a short-term plan. So do you have a rainy day fund out there that you can tap into? Do you want to tap into that rainy day fund very quickly and exhaust that before something starts kicking in from another source like an income protection policy?
Okay. So I guess once you've determined how much you want, then you start to shop it around and see how much it costs, right? Because you've got to be able, you probably should be able to afford it because it is, like we were talking, a very important part of your financial plan, but price, I'm sure, is always an issue. And then I guess there's some type of underwriting that you go through when you apply, or?
Yeah, one of the key elements that I focus on is it may not be the most comprehensive type of plan, but I try to keep the premium for clients in and around 1 to maybe 2% of their overall income, whether that's monthly or annual. Okay. So for those of you listening right now and you're thinking to yourself, what's this going to cost me? The idea is, how do we design the plan? But to you, the 1 to 2% income is going to get you something. It may not be what I'll refer to as the Mercedes-Benz plan, but it's absolutely going to cover you for a period of time. So as you look at your financial budget, think about 1 to 2% of your monthly income, if you will, and the plan can be designed accordingly for you, but it may not be, again, a Mercedes type of plan. The other side of that is, then, Ryan, to your question, there's an application process. There's a phone interview process. So the carrier that you're applying to is going to call you as a client and ask you specific questions around your medical history. And then based upon your age and the amount of benefit, monthly benefit you're applying for, that's 60% of your income, you may have to do some sort of medical, whether that's blood or urine or something like that. You may have to do something along those lines, again, based upon your specific age and the amount of benefit you're applying for.
Okay. So similar to most life insurance.
Correct. That's right. Yes.
And then, so once you get it, as long as you keep paying the premium, I'm assuming it's yours for until you hit retirement age or Social Security age?
Yeah, that's a great point. So with these types of policies, there's no requalification period with these policies as long as you said you keep paying the premiums, right? I've now owned my own policy on myself for over 25 years. I bought mine early in my career. Thank goodness I knocked on wood there that I've never suffered a disability event. But if I do, I've got the policy behind me, and I've never had to requalify to keep that policy in place at this point. And that is a nice security blanket for me as I get up in age now. A disability event health-wise is more likely to occur versus when I was in my 20s when I bought the policy, but you never have to requalify for that policy.
Sure. And I guess at any point, this makes sense. You're talking 20s, but if you're in your 40s or 50s and you realize you don't have adequate coverage, it's still appropriate to probably consider pursuing this, right?
Yeah. When I present to advisors and talk about clients, my thought process is anybody who has an income, that's the first thing. If you have an income, this is a policy for you. Secondly, if you're between the ages of 25 and 55 years old, to your point, and you don't have income protection, that's the time, right? If you're below 25, you're not worried about an accident or a sickness. If you're above 55, you can still qualify and get a policy. But at that point in time, you might be looking more towards a long-term care type of sale or just a retirement type of planning process. And you're not as worried about if an income event happens. But still, you can buy these policies up until the age of 60 or beyond. But the buying age is typically about 25 to 55 years old.
Okay. And so you probably, do you look at multiple companies when you get this?
Yeah, we shop the marketplace for, in this space specifically, a little bit different than life insurance where they look at your overall health. The disability carriers look at your occupation specifically. So if you're a ditch digger, a bulldozer operator, the CEO of a company, if you think about it, then based upon your occupation, you're more susceptible or less susceptible to a DI event, even though, as I mentioned earlier, most of them are sickness related, but they do cover you for accidents. So if you're a tree trimmer, you're most likely going to pay a little bit more for your policy than an accountant sitting at a desk all day. So we look at multiple carriers to provide you the best option for you based upon your specific occupation.
Okay, that makes sense. And I guess, too, with certain occupations, the policy could be designed where if you couldn't perform just that job, then it would cover you, right?
Yeah, the disability, again, versus a death event, the death event is pretty straightforward. The disability event, to your point, is we see a lot of physicians buy this coverage that are surgeons. So if they end up with carpal tunnel or arthritis in their hands, they'll never do surgery again. They'll live a long and happy life. But because they did so much training to become a surgeon and they'll never do surgery again, they can actually start collecting their disability benefits because they can't do surgery. They can transition to a new occupation, but their policy protected them specifically as a surgeon, and they'll collect the benefits out of that policy.
Okay. Makes sense. All right. I think we've covered a lot. Is there anything else you want to add?
Yeah, one other item that I'll add just to end with is a lot of clients look at other ideas around the income protection policy, and some of those, again, are like workers' comp and Social Security. Workers' comp, again, for those of you listening, is only an on-the-job type of event. So if you get hurt or have an accident or sickness away from the job, that's not a workers' comp event. And when you look at Social Security disability these days, Social Security disability is a lot of clients fall back for this type of conversation we're having, but it is very hard and it's a very arduous and long process to qualify for Social Security disability benefits. That's why you see so many lawyers advertise in the evening news, have you been denied for Social Security disability benefits? Right now, the average wait time to get your claim through is over 2 years from when you have the initial claim. So again, if you're looking at what other options you have, workers' comp, Social Security, they're out there, but there's real specific criteria for you to be able to qualify for those events versus what Ryan and I are talking about here is a premier type of income protection plan that makes it a lot easier for you to be able to collect out of the policy.
Yeah, that's a good point. Yeah, I mean, I've heard Social Security, you can take a minimum of 18 months, right? Because 6 months you have to be on disability and then you have to wait 12 months, but it sounds like it could take even longer, right?
Yeah. I mean, through everything that's gone on over the last couple of years and people getting backlogged administrative wise, the last time I read up on it was not that long ago. It was over 2 years for them to process an initial claim for Social Security disability benefits. And 7 out of 10 of those initial claims are denied coverage. So then you go through the appeals process and that takes even longer. So again, that is not the best thing to look at if that's going to be your financial security blanket if you get sick or hurt.
Yeah, that makes sense. All right. If people want to reach out to you, Tim, how's the best way to get a hold of you?
Yeah. So from my side of things, I appreciate the question. So again, it's Tim Kukieza at Ash Brokerage. I'm part of the disability team. The number is 800-589-3000, 800-589-3000. And if you want to have a conversation either with myself or with Ryan around the income protection plan, I'm happy to have that conversation.
Okay, great. Yeah, I'll put a link to your information in the show notes too, so people have it. So thanks a lot, Tim. Appreciate getting your wisdom here on disability insurance and hope that everyone enjoyed getting a little more informed on that subject. If you're enjoying these podcasts, please subscribe through your favorite podcast app. And if you are listening on Apple Podcast or iTunes, I would always appreciate you leaving me a 5-star review. Have a great week, and I look forward to talking with you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.